A warm welcome on behalf of WealthFunda. This is a small initiative to impart basic knowledge in finance related matters concerning individuals. This video will explain how one should understand the salary slip, which is something you hope to receive every month. This is something highly anticipated as the month end approaches. You may or may not be happy with it. If you're not happy with it, this video will help you. We answer the question, how do we increase the net pay? That is, take more money home. This question crops up in our mind every time we see the salary slip. How could I get more money? It is just not enough. We will help you answer that question, and we hope that the answer will help you. Let us start with how a salary slip looks like. A typical salary slip consists of two halves. Allowances indicate the incoming money, the good part of the salary slip. Deductions indicate the outgoing money, the broadly bad part of the salary slip. What these allowances and deductions mean will be covered later in this video. For now, the net pay that you take home is the deductions subtracted from the allowances. So, if you want more money to take home every month, how does one do it? The way to do that is to reduce the deductions, as this is the outgoing component of your salary. Decrease the deductions, increase the net pay. But deductions can be of two types. Deductions in your control. That is, you can decrease or increase them. Deductions beyond your control. These are the deductions that you just cannot stop. There is no way you can stop them. For example, the mandatory provident fund contribution, which is a good deduction beyond your control. Professional tax, your travel cost to go to the office for your job that you're so desperately dependent on. So, the deductions that are under your control can be brought down if you reduce your taxable income. That brings us to the next question. What is taxable income? Taxable income is the income taken for tax calculation. This is not the same as your gross income. It is the income that will be considered to calculate tax. This is arrived at through the following steps. Step 1. Take your gross income. This is what you originally agreed with your employer to get paid. Step 2. Identify the tax exempted allowances. We will talk about this in a few moments from now. Step 3. Avail the exemptions as per law. Law allows you to claim some exemptions. We will see what these are later. Step 4. Take the result of steps 2 and 3 and use them to decrease the deductions. Let us have a look at what each of these steps are in detail. We move to step 1. Take the gross income, which is the sum of all allowances and your basic salary. Now, as spoken earlier, we leave the deductions that are not in your control. Provident fund, profession tax, and transport deduction. Alright, this completes step 1. That leaves you with two deductions that are in your control. income tax, and loan. Loans of several types taken from any institution can also be used to reduce your deductions, which will be covered later in this video. We now move on to step 2. There are certain allowances that can be fully or partially removed from the taxable income. This means you need not pay tax for the amount of that allowance. So, we identify all the allowances which need not be included in the calculation for your taxable income. This means you are going to pay lesser tax. Which are those allowances which are fully or completely tax-free? The first allowance is the medical allowance. Under this allowance, you can bring down your taxable income by up to rupees 15,000 per annum or rupees 1,250 per month. Producing medical bills for the amounts makes the allowance tax-free. A popular, often asked question is whether this is a reimbursement of your medical bills. Unfortunately, it pains us to tell you that it is not a reimbursement. You can reduce the taxable income by the amount of money spent on medical bills up to a maximum amount of rupees 15,000. Anything spent above rupees 15,000 cannot be claimed. If you don't have any medical expenses and hence no bills are submitted, the same amount will be added to the taxable income. So, the rupees 15,000 will be taxed according to the tax slab that you are in. Conveyance allowance. A maximum amount of rupees 800 can be removed from the taxable income if your company is providing this allowance. Did you know that going for a holiday with your family not just burns a hole into your purse? It will actually help you reduce tax. The expenses paid by the employer twice in a block of 4 years for this is exempt from tax. This covers the travel expenses, that is the fare only, within India with your family. This will cover only the fare of the ticket and not the other expenses of your trip. This will not cover your food expense, your shopping expense at a tourist location. This is useful in cases where the LTA or leave travel allowance is included as part of the CTC, that is, cost to company. Most of us dream of buying a house and spend our entire life realizing it. But till you realize it, you have to make do with a rented house. For those paying rent for accommodation, exemption is allowed for the house rental allowance received as under the following formula. It is the minimum of 1. The rent paid, the actual HRA paid by your company, 50% of your salary if you are living in a metro, or 40% of your salary in case you are living in a non-metro, and finally the actual rent paid minus 10% of your salary. Let us now have a look at an example so that we understand this better. For the sake of the example, let us assume that your salary is 1,28,000 per annum. This means 10% of your salary is 12,800 rupees. 50% of your salary is 64,000 rupees. Let us now have a look at the individual components that go into the calculation of HRA. Let us assume that you stay in a small house where you pay 3,000 as monthly rent. This means the rental outgo is 36,000 rupees, as we have only 12 months in a year. Let us assume that the actual HRA paid by the company is 30,000 per annum. 50% of your salary, as already calculated, is 64,000 rupees. The rent paid minus 10% of your salary will be 23,200. So, the minimum of all is nothing but 23,200. This means the portion of HRA paid by the company that is taxed is only 12,800 rupees. What this means is an amount of 23,200 rupees is not taxed. We now move on to step 3. Tax exemptions can be claimed under two heads: expenses you incur, which is something you cannot stop; investments you make, which is something you want to increase all the time. Let us have a look at the different exemptions as per law. Section 80C of the Income Tax Act. Certain investments and expenses amounting to a maximum of rupees 1 lakh can be reduced from the taxable income. You may reduce your taxable income by making the following investments subject to a maximum of rupees 1 lakh per annum. Provident Fund contribution. This is the amount that the employer deducts from the salary for contribution to the Provident Fund. The employer contribution cannot be included in this, only your contribution. Voluntary Provident Fund. In addition to the Provident Fund, this is the amount that you may contribute to the Voluntary Provident Fund. Life insurance premium. Equity linked savings schemes of mutual funds. These are tax planning mutual funds, popularly known as ELSs, where most of the money is invested in equities or stocks. Housing loan principal amount deduction. This is the portion of the EMI for home loan which goes towards repayment of the principal amount. Tuition fees for up to 2 children. Senior Citizens Savings Scheme. Bank fixed deposit for 5 years and not less. Savings in post office time deposit with 5-year lock-in. Investment in pension plans. The next section is section 80D. Under this, the premium for medical insurance for self, spouse or children up to rupees 15,000 and an additional rupees 15,000 for parents, rupees 20,000 if the parent's age is greater than 60 years, is exempt from tax and can be reduced from the taxable income. Preventive health checkup of rupees 5,000 is also within the above limits. Section 24. This is the component of the EMI for home loan which goes towards interest. The amount can be a maximum of rupees 1,50,000 if you are staying in it, or self-occupied property, and unlimited if you have let it out. Section 80E. The interest for educational loans for graduate or postgraduate course. No deduction can be availed on principal repayment. Section 80G. Deduction for donations to charities up to 10% of gross total income. The next section is Section 80DD. Deduction up to rupees 50,000 or rupees 1 lakh for medical treatment for a dependent with disability can be reduced from the taxable income. This amount depends on the type of disability and a medical certificate from the doctor. Section 80DDB. Deduction up to rupees 40,000 for treatment of specified illness can be reduced from the taxable income. Section 80CCF. Investment in infrastructure bonds up to rupees 20,000 can be reduced from the taxable income. Now we have reached the last step, step 4. Take the result of step 1, which is the gross income. We call it A. Add the different allowances from step 2. We call it B. Add the different exemptions from step 3 subject to their limits. We call this C. So the net taxable income is nothing but A minus sum of B and C. This is how you reduce your taxable income. The less your taxable income, the lesser your tax deductions, and the more is the net pay that you take home. Thank you for viewing this presentation. We hope this video was useful to you. Please write to us at WealthFunda for further information, assistance, and suggestions for improvement.